Over the last 5 years, Nike has seen a huge run up in its stock price and is up over 103%, but year to date we can see this is a company that's down nearly 35%, which is much more than the S&P 500 as a whole. So this leads to the question, is this a company that's worth looking into buying? Well, in this video we're going to be jumping into my stock valuation spreadsheet where we have 4 different valuation models to calculate the intrinsic value of Nike. We have Graham's valuation, a discounted cash flow model, multiples valuation, and a dividend discount model, and all 4 of these will roll into our output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to use this spreadsheet for your own use, then you can head over to my Patreon page at the link in the description. Okay, let's go ahead and come up here and we're going to plug in Nike stock ticker and hit enter, and we can see all this data is going to fill in automatically. Now obviously, like I just noted, we can see a huge decline in the company's share price over the last 365 days. Let's go ahead and zoom out and look at a 1,000-day chart. We can see this 1,000-day chart, we have seen a huge run up, but this decline makes me wonder if there is an opportunity with this company. Let's come over here and look at the dividend data. We can see they're paying out $1.22 per share, dividend yield of 1.14%, and a nice safe payout ratio at about 29.2%, leaving them room to continue to grow their dividends while increasing their business operations. Now, obviously, their 20, 50, and 200-day moving averages are all negative due to the huge decline they have seen in their share price, 1-year return of negative 17.5 and 2-year return of about 12%. Now, something we definitely need to take note of is what their industry is, and that is consumer discretionary. Now, why is this important with the current market conditions? Well, with the threat of a looming recession, typically companies in this industry have a pretty big risk involved with how the market is going to play out. So if we scroll down here, we can see as more evidence of a consumer recession grows, Nike stock could be at a risk of adding to its losses. So this is obviously an industry that's very reliant on current market conditions. Analysts do have a current price target of about $160 per share, which is quite a bit higher than the current price, and we can see institutional ownership is about 83.3%, which is pretty high, which is a pretty positive sign for this stock. But let's go ahead and jump into our valuation models to see if we can find the intrinsic value of this company. The first one we're going to look at is Graham's valuation. Now, we know that Benjamin Graham was a mentor of Warren Buffett, and he laid out this formula for us to calculate intrinsic value. So let's go ahead and plug in our numbers, and the first thing we need is our earnings per share, which we have listed right here. We're then going to multiply it by 7, which is the price to earnings of a company with no growth, and then we're going to apply our growth rate projection. Now, analysts, despite the looming recession, are projecting a pretty fast growth rate for this company at 15.5. We then multiply that by 4.4, which is the average yield of corporate bonds, and then we're going to divide that by Y, which is the current yield of AAA corporate bonds, and at the time of this video, that's sitting at about 4.16. So we can see based off of this, the intrinsic value for Nike is about $90 per share. Now, obviously, the AAA corporate bonds current yield has gone up quite a bit over the past few months. Earlier this year, it was as low as 2.5. So we can see with those current market conditions, when it was at 2.5, the intrinsic value would jump all the way up to about $150 per share, which is a lot closer to the analyst price target like we just saw earlier right here. Now let's go ahead and jump back over and we'll switch this back to 4.16 and keep moving forward with our other valuations. The next one we'll look at is our discounted cash flow model. And in order to perform our discounted cash flow analysis, we need to project a growth rate for the future free cash flows for this company. So what I've done is I've looked at the historical free cash flows for Nike. We can see over the past 4 or 5 or 6 years, they actually had an average growth rate of about 68%. Now, that's obviously due to some huge jumps in their free cash flow. We can see they had a year with 44%, negative 70%, and then a huge jump up in 2021 of 326%. Now, based off what they've done historically and industry expectations, obviously we're not going to go with an average growth rate of about 68%. A much more realistic growth rate for this company is going to be a lot closer to about 12% most likely. So using this growth rate, I was able to project forward the future free cash flows of this company. Using that growth rate, I also projected the terminal value, which is the sum of the future free cash flows past the year 2030. After I had this, I found the present value of all of these future free cash flows and added them together, which you can see right here. After adding the company's cash and cash equivalents and subtracting out the total debt, we were able to find their equity value. Once we had that, we just divided by the number of shares outstanding, and we found a discounted cash flow price per share of $156, which again is pretty close to what analyst price target is currently. Now let's look at our multiples valuation now. And obviously the idea behind our multiples valuation is using using a price to earnings multiple, we can see how the market is valuing similar companies and apply that average price to earnings multiple to Nike. So what we're doing is we're taking companies like Under Armour, Adidas, we're looking at their stock price, we divide it by their earnings per share, which gives us their price to earnings multiple. After getting these price to earnings multiple, we take the average of the two, we multiply that by the earnings per share of Nike, and that gives us an intrinsic value of $63.21 per share. Now that is much lower than the company is currently trading at. So what's the reasoning for this? Well, we're actually going to come back to that in just a little bit. But let's go ahead and look at our dividend discount model. And the idea behind our dividend discount model is we should be able to value a company based on how much they pay out in dividends and how much that dividend is increasing. So what I've done is I've plugged in how much the company's been paying out in dividends quarterly over the past 4 or 5 years. So then we can see how much their yearly dividend payout is. This allows me to see the growth rate over the past few years, and we can see they've had a pretty great growth rate for their dividends over these past 4 or 5 years. Average growth rate of about 11.13%. So this is actually a much better dividend growth company than a lot of people realize. And if we jump back over to our stock screener, like I mentioned earlier, we can see that payout ratio is pretty safe, sitting at about 29.2%. So no threat of cutting their dividend there. So based off of this, I'm projecting a future growth rate for their dividend of about 7%. That's a little bit of a decline. That's typical, but 7% growth rate is still really good. So after applying a discount rate of about 8.5%, we can see we come to a dividend discount model price per share of $87. Now let's go ahead and jump over to our output tab. And here on our output tab, we have all 4 of our valuation models: grams at 89, multiples at 63, DCF at 155, and dividend discount model at $87 per share. So what's the reasoning behind our multiples valuation being so low? Well, obviously we've seen a huge market decline over the past few months, and because of this, each of these companies are going to have lower price to earnings multiples. So it would be much more effective to typically look at the historical price to earnings multiples for these companies, and because of that, I don't think this is providing a very fair valuation. So let's go ahead and say we want to take out our multiples valuation in this scenario. With that being said, our intrinsic value would be about $110 per share. Now the current price is $107 per share, so our intrinsic value is very close to that current price. But let's go ahead and apply our margin of safety as value dividend investors. We'll say a 20% margin of safety. And because of our margin of safety, we can see our acceptable buy price for this company is about $88 per share. So this stock valuation spreadsheet is telling us this is not a company we should be currently buying, as the current price is $107 per share. So as for me, I was surprised. This company has much better dividend growth than I was expecting when I started to look into them. So I'm going to be adding them to my watch list, but I would like to see them go a little bit lower than they currently are before I buy into this company. I think the threat of a looming recession does make this a little bit more unattractive of a company, but I think long term they obviously have an extremely strong brand, great dividend growth, and great discounted cash flow analysis model, free cash flow growth. So that's a really positive sign as well. So long term, I think the company's in a good position, but I would like to see it go a little bit lower before I consider adding shares to my personal dividend portfolio. But go ahead and let me know in the comments below what you think of this company and if you own it or if you plan on buying it. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.